Welcome back, everyone. Today on the Joseph Carlson Show, it is a bloodbath out there. The stock market has had a tough couple of days. Tech shares logged the worst day of 2024, and that was yesterday. Today, the stock market continued its decline, with the Nasdaq leading the way. In fact, many of the growth winners this year have been the biggest losers over the past couple of days. We'll be looking at why the stock market is trading down and what I do in situations like this. I've also made some trades myself. I completely exited one of my positions. I've sold entirely out of the stock Chipotle, and I want to go over why I exited that position and what I'm doing with the proceeds. Now, we do have some earnings reports to go over as well. Domino's, this franchise restaurant, had a very tough day. It's down 13%, trading lower on mixed Q2 results. There's a common thing happening in the food industry. It's discounts, promotions, and free giveaways. This is a highly competitive area, and these companies are trying to keep their customers as best they can. Companies like Domino's are having to give away more and more free goodies. But this has led to the company lowering its guidance and giving disappointing results. We'll be going over what this means for the future of the food industry. Netflix also just reported earnings, gaining a net 8 million new subscribers. The ad membership went up 34% in the quarter. These are decent numbers, but the stock is reacting by going down nearly 3%. We'll be looking at why investors are selling on this news and diving into a bit more of the Netflix numbers, as I'm a shareholder of this company. Now, we also have news that Prime Day is off to a really strong start. In fact, they made $14.2 billion on their first day. And we have the news, this is real news from the Wall Street Journal, that the multi-billionaire Ken Griffin paid $45 million for a Stegosaurus. That's right, he literally bought a real dinosaur. As a dinosaur fan, I want to go into why this is good news. So we have a lot of news to get to. Let's go ahead and jump in. To start things off, we can take a look at the overall market. We're looking at my portfolio right now. I have a lot of money invested in the market. I basically stay 100% invested at all times, but I do have a little bit of cash right now. Currently, I'm holding $15,000 of cash. Don't be confused by the margin or my total buying power. That's as if I took out a loan. Right now, I don't have any margin. I don't have any debt. I haven't taken out any margin or loans to fund this portfolio. When I look at my portfolio, the overall goal is to hold a group of incredibly high quality companies and to hold them well, to invest in these companies for the long term, and to make gains when they have multiple expansion and free cash flow per share growth. I want companies that can compound their free cash flow per share at a rate of 15% or above, which is about double the average of the market. So I'm looking for very high quality companies. Now, from time to time, I do swap some companies for different ones. I make slight changes to the portfolio. Over the past couple of years, I've kept my portfolio somewhat the same. I have a lot of the familiar names: S&P Global, MasterCard, Intuit, and Moody's. All I've done with all four of these stocks is add to them over time. All of them have been successful companies, moving well into the green. In the tech category, we have Microsoft, Salesforce, and Apple. These are all three very high quality tech companies. Salesforce is the newest one, and it's in the red right now, but I have a solid belief that if I hold this one long enough, it'll work its way back into the green. The company's increasing their free cash flow per share, they're growing steadily, and they have a very dominant market position. Now, if we continue down this list of my holdings, we get into the consumer category. My top position in the consumer category is my only physical retailer, which is Costco, which I've not ironically said is the best company in the world. When you consider the qualities of it, its dominant moat, the way that it earns money, the way that it treats its customers, its shareholders, and communities, I really believe that Costco is the best company in the world when all those aspects are considered. Costco's been a really fun stock to hold because it's not only a great stock, but it's just a great company all around. The other one that I introduced recently into the portfolio just a few days ago is Booking Holdings. Now, I've come out with research on this one. The thesis is pretty simple. It's a company that has a digital platform, a lot of different things that have to do with travel and leisure and experiences. Booking Holding owns a highly profitable digital platform where they offer all of those different services to millions of customers. They make money by brokering different deals with hotels and connecting customers to different parties. Booking is one of these odd companies that doesn't like to do share splits. The founder of it has said that he doesn't really care about that because he's not trying to attract shareholders that are looking for short-term gains. If we look at the valuation of Booking, the reason that I'm going into this stock right now is it trades at a relatively low valuation compared to the overall market. The S&P 500 trades at a 23 forward PE. Booking is at a 20. The S&P 500 has a 3.7% free cash flow yield. Booking is at a 4.6. It is cheaper than the overall market-weighted average of the S&P 500. And while it's cheaper, it's growing its free cash flow per share faster. So I view this one as a good risk and reward. To fund the purchase in Booking, I have added additional capital to the portfolio, but it's been funded primarily through the sale of one of my restaurant stocks. I sold entirely out of Chipotle. I know, it's sad to see it go. The burrito company used to be right here, and I sold it with around $11,000 in gains. What I've seen over the past year is people become more and more concerned about value, about the value they're getting out of their meals. With Domino's, for example, this company's report was not great. It was very mixed, which is a euphemism for saying that it was much worse than expected. They have to give way more discounts to people to get them to buy their pizza. They're giving more discounts on their website. You can go there and they'll give free vouchers and free pizzas and different mixes of meals. Anytime a food company is giving out promotions, that is basically cutting the price of their product. They are slashing prices. They're lowering prices on their product, which of course makes their earnings more difficult. Domino's is one of the many companies doing this over the past year. We also have the example of Starbucks. Starbucks had one of the most abysmal reports I've ever seen from a food company. It was bad in virtually every aspect of the company. Earnings were below expectations. Revenue was below expectations. The company opened fewer stores than expected. The company even lost the rewards members from one quarter to the next. It actually went down sequentially. Overall, Starbucks had a problem. Consumers were pushing back against the high prices of their drinks, and Starbucks had a result into giving out lots of promotions and goodies on their app to try to entice customers back. But doing so is a price reduction. They're lowering prices. McDonald's is facing the same problem. We've heard so many people complain about the value of a McDonald's meal. And it's true, McDonald's has increased prices to the point where they're being treated like almost like a premium place to eat, when in reality they should sell really cheap food. And McDonald's customers have been pushing back. In fact, McDonald's customers pushed back so much that the company lost so many different customers that they were forced to offer a $5 meal, something we haven't seen for years. All of this for $5? That's certainly not going to have the same profit margin that their $10 or $12 meals had. McDonald's is lowering prices as well, offering customers different options that are much cheaper. Now we get back here to Chipotle. Chipotle is one-of-a-kind company. I do believe it's in a different category than McDonald's or Starbucks or any of the rest of them, because there's not any other company at Chipotle's scale that offers the type of food they do. Chipotle is also known to have very high-income consumers. So unlike McDonald's, where you have a lot of lower-income customers, Chipotle targets people. They really attract customers that are making upwards of $80,000 a year. So the customer base of Chipotle is more resistant to price increases. But even Chipotle has its limits. And as the stock has raced up, surpassing competitors over the past year, I've grown a little bit more concerned about the potential to see a slowdown in their pricing power. For Chipotle being forced to go a couple years without raising prices, and that dampening the growth of the company. Now, I want to make sure something is clear here. Just because I sell a company does not mean I believe it's going to go down. It does not mean I'm bearish on the company. I still believe Chipotle is an excellent company. I still believe the qualities are intact. But right now, Chipotle is a very high multiple company at a 55 forward PE, a 1.6% free cash flow yield, and it's one that's trading in an industry that overall, I see a lot of challenges, a lot of price increase challenges within the food industry. So I thought, considering all of this data, it was a decent time to consider the portfolio, look at my positions, and one of them that has the highest valuation of any stock in my portfolio is Chipotle. And since I currently had around $11,000 in gains in that position, I thought it was a wise time to take the gains and deploy them into other companies that I don't really have the same concerns for. With those gains from Chipotle, I'll be deploying that capital into other positions, including Booking Holdings, as I build up this position. Now, there's no guarantees that Booking will do better than Chipotle. Maybe Chipotle will continue to race into the sunset and it will be one that I shouldn't have sold. But as is the case with investing, the goal is to make yourself in the best position to have the most predictable route of good returns. And I believe I'm doing that in this scenario. With this sale, I also plan on keeping a decent amount of cash on hand. I'm going to hold this cash through this earnings season so that I can deploy it directly into any company that has a huge sell-off. If I have a position that goes down 6 or 7%, and I believe it's an unjustified move based on the fundamentals, I'll deploy this cash into it. If every company that I own goes up, then I will deploy it into the one that I think offers the best value. So there you have a little update on my portfolio. Now let's go ahead and take a look at the rest of the market. We have 2 days in a row now of the Nasdaq selling off and many of the top leader stocks falling down even more. Now they credit this to the president, saying tech stocks got hit by President Joe Biden's comments this week and have concerned the market about ongoing trade war in the semiconductor industry between the US and China. With the Nasdaq still up in single digits for the year, investors don't want to take additional risk yet, so they're selling. I think this could play a small role, but I don't think this is the primary reason that investors are selling out of the Nasdaq. The truth is, these companies have just done really well. Companies like Google and Microsoft and Apple have outperformed the rest of the market to such a huge extent that a sell-off is inevitable. It's something that's going to eventually happen. Look at Google year to date. It's currently up 28%. Apple is now currently up 20%, again beating the rest of the market and pulling up the S&P 500. And keep in mind, the difference between these big tech companies and the S&P 500 would be even greater if you subtracted their outperformance from the S&P 500. Amazon is also down today after having news of a great Prime Day. This is another stock that's above the S&P 500, up 22% year to date. I know I sound like a broken record here because I'm essentially saying the same thing every time we see a decline like this. You can try to target exactly what's the cause, whether it's something Biden said or Trump said. I don't think that's the big picture. The big picture is these stocks have outperformed to a huge extent and a temporary sell-off is inevitable. These stocks are going to sell off eventually. When I look at big tech overall and the positions that I hold, and I try to determine their valuations and whether or not they're at their intrinsic value, I believe the days of big tech being really cheap are gone. That's something that happened around a year ago. Now big tech is at price points where they have higher expectations. Microsoft and Apple are not trading at very cheap valuations. If we look at the story fund, my secondary growth portfolio, we also have companies like Amazon, Netflix, Google, and Microsoft. Again, these companies are not trading at the cheapest valuations. Just a year or two ago, they were trading at much cheaper prices. So we're at a point where these companies have a lot more to prove. And going into this earnings season, I think a lot of investors are becoming concerned about the gains they've recently made and whether those will maintain. But as of right now, I don't consider big tech a sell. I don't think the QQQ is a sell. And I still believe investors will do better over the next 10 years, weighting big tech companies a greater portion of their portfolio than selling out of them. Now moving on, we just had Netflix report their earnings. If we look at the current stock trading, it's down 2%. It's been bouncing around from minus 1.5% to 2%. And this is something that frequently happens with Netflix. After they report earnings, the stock is very volatile and then it eventually recovers. 3 months ago, Netflix reported earnings, it fell 10%, and then within 1 week, it had recovered that 10% fall. Like it just never happened, and it rose from there. So Netflix is a stock that's always a bit volatile around its earnings, and that's something that I really don't factor in when I look at this company. Now keep in mind, as we review this, I am a Netflix shareholder. I've been a big advocate of Netflix stock over the past couple of years. It's been a winning position for me so far, but I'm still very bullish and very optimistic about this company, and I thought this was a fantastic earnings report. Really, I thought this was a great earnings report. We can first start by looking at some of the key numbers here. We have the revenue. This was $9.56 billion. This beat the analyst estimates of $9.53. We have the earnings per share, which was $4.88. This beat the analyst estimates of $4.74. That's around a 50% earnings per share gain. So they beat on the top and bottom line, and we look at the subscriber net change. The estimate was for 4.87 million subscribers, and they once again just crushed it. They had 8.05 million subscribers gained. So whether you're looking at the top and bottom line, whether you're looking at key indicators, it really looks good in terms of this most recent quarter. On top of that, they note that the ad-supported tier rose by 34%, which is rather strong. Netflix actually says in their earnings report that their ad-supported tier is growing so fast, it's scaling so insanely fast, that they don't have enough ads to share with that many people. They're trying to fill the ad slots because they're growing the amount of advertising supply greater than the demand. That's the situation that they're doing. In the shareholder summary that was just released, Netflix notes that they grew their revenue by 17%. A lot of people refer to Netflix like it's a slow-growing or mature company, but there's not many slow-growing, mature companies growing at 17% per year. They've re-accelerated their revenue growth. Their operating margin is now 27% versus 22% last year. So you have a revenue growth and you have an increase in operating margin. If we look at some of the other key performance indicators here, we have a few of them in Qualtrim, one of them being the revenue by region. We can look at this on the spreadsheet, but it's a lot easier to see how things are developing charted out here. For example, this is the entire revenue per region of Netflix over time on a quarterly basis. Overall, with all the regions added together, we have the 17.2% revenue growth. But we can look at it region by region. In the US, they grew revenue by 19.37%. They're turning on the monetization, the advertising revenue, and they're increasing prices in the US. We have in Europe, the Middle East, and Africa, revenue grew by 17.41%. In Latin America, it grew by 11.79%. And Asia Pacific, it grew by 14%. The revenue is growing the fastest in their most mature markets because they're leveraging their already dominant share there to continue their pricing power. But overall, Netflix can be viewed as a business that's growing in every corner of the world. They're growing everywhere but China and Russia. If we bring up the total subscribers, they're still reporting this until the end of 2024. They're no longer going to report subscribers at the beginning of 2025. This last quarter, they had 277.6 million subscribers, an increase of 8.05 million subscribers. So you can see the growth over time. We had the slow period right here. This is when investors got really concerned that subscriber growth slowed down, the stock sold off, but it continued to reaccelerate. Netflix is on track to gain above 400 million subscribers. They believe their TAM is greater than 400 million. So they're on that path. They continually go forward a little bit every single quarter, gaining an incremental net millions of subscribers. If we visualize the amount of subscribers they gained per quarter, it is decelerating over the past 3 quarters. They had that monstrous quarter in Q4 of last year of 13 million. And then the quarter previous to this one, they gained 9.3. And then this most recent quarter, they gained 8. So it is decelerating, but these are still very strong quarters. This company continues to increase prices and gain subscribers at the same time. Another thing that I think is great to look at from Netflix is their content budget. This is something that's a little bit more difficult to find, but it gives you an illustration of the operating leverage of the company. How is Netflix growing its margins so fast? Well, they're gaining in revenue and subscribers while keeping their content spend relatively flat. They're spending around $7 billion per year in content. And if we look at that on a quarterly basis, last quarter they spent $4.05 billion. So if we extrapolate that, they're going to come in at around $16 billion for the year. Now, if Netflix spends around $16 billion in content this year instead of $17 billion, Wall Street will be around $1 billion short on their estimate for free cash flow. They're estimating that free cash flow will be around $6 billion this year. If they spend a little less on content, which I believe they will, they'll have another year of $7 billion in free cash flow. That'd be an incredibly strong year for this company. Netflix continues to execute as the dominant subscription media platform in the world. Their global playbook is on track. They're growing in every region of the world. They're executing well, growing an advertising stream. They have different events that are going to come online next year. They're going to have WWE wrestling every single Monday starting in 2025. They'll have things like Jake Paul versus Mike Tyson. Lots of fun events to make Netflix more of a staple in people's household and make viewers a bigger lifetime value for the company. Sure, you can say I'm biased on Netflix. You can point to the fact I own the stock. And I realize that everybody wants their stocks to do well. But when I say that Netflix remains one of my biggest convictions in my portfolio, I'm saying that seriously. Right now, the stock has wiped away all of its losses, and it should. This was a fantastic report all around. The bar is higher for this company. The valuation is higher than it was a year ago. But even considering the current valuation, I still consider Netflix to be one of the best growth stories in the market. And I don't plan on selling it anytime soon. Now, we also have news that online sales was driven to a record high. They say that online spending in the US surged 11% year over year to $14.2 billion during Amazon's 48-hour Prime Day event, topping estimates and setting a record according to Adobe Analytics. So this is not exclusive to Amazon. This is just the total online sales in the US during the Amazon Prime Day event, which was a 48-hour event. Adobe says that this was driven by back-to-school shopping, a parent product refresh cycle, consumers looked to snap up new tablets, TVs, Bluetooth speakers in droves. Last year, people were buying household essentials, like pantry staples and office supplies. Now, based on this report, this is including the total online sphere in the US. What Amazon earned in particular has not been released. They said that it was a record-breaking Prime Day, So they had another sequentially record-breaking Prime Day, but Amazon has not yet released the total amount. I'm assuming they will once they gather all the analytics over the next day. It's clear to me that online shopping is not just some short-term thing, it is a long-term secular trend. Over time, online shopping will continue to take market share from retail shopping. I think there's going to be some physical retailers that never go away, especially ones that sell things that are very hard to ship, ones like Costco. But in terms of the online market share, Amazon is the primary winner of these type of days and the secular trend. So as an Amazon shareholder, I feel very good about hearing this record. Now finally, we get to some of my favorite news to read. We have a multi-billionaire here, hedge fund manager, Ken Griffin, who purchased a Stegosaurus for $45 million. According to the Wall Street Journal, this is the most ever paid for a fossil at auction. The 150 million year old dinosaur, nicknamed Apex, was only expected to sell for up to $6 million. Its sales surpassed the $32 million paid 4 years ago by Abu Dhabi for the Tyrannosaurus Rex skeleton, widely known as Stan. The sale also soared past the $8.4 million paid in 1997 for another T-Rex named Sue, now on view at Chicago's Field Museum. Ken Griffin, the 55-year-old founder and chief executive of Citadel, said the aim is to lend Apex to a museum in the US. Quote, Apex was born in America and is going to stay in America. So he bought this enormous dinosaur and paid a huge premium for it, and his motivation seemingly is to keep the thing in the US. So a rich Saudi or someone from a foreign country doesn't purchase it and ship it out of the US into one of their museums. And for that, I stand by him. I think that this is an awesome buy. So I realize that Ken Griffin is the bad guy in the GameStop story. He's one of the big funds that shorts different companies like GameStop. But if you put that aside, I think this move is pretty cool. He's investing a lot of money into securing a dinosaur so it can stay within the US. And not only that, but paying a premium for these fossils has to have a downward effect on funding future development in paleontology and trying to dig up more fossils like this in the future. On a side note, as someone that really loves dinosaurs, one interesting fact about Stegosauruses is they're not really sure what these things do. These large bones on their back that act like fans, they don't really know. They think they may have had these to look more big and scary to their predators. Another theory is that they had these as kind of radiators to cool down as blood flows through them, but ultimately they haven't quite figured out what these big tall bones are. Hopefully as time goes on, we'll be able to figure out more about these dinosaurs. Now that's it for this episode. If you like this type of content, make sure you subscribe to the channel. And if you want to see more exclusive episodes, you can do so by joining the Patreon in the description below. That's all for now. See you in the next one.